Banks are taking a hit in the pre-market.
Berkshire Hathaway cut its stake in the company to 3.3% from 6%.
What else can't be touched? The banks.
Bank stocks. They were once Warren Buffett's fun favorites. But the recent fall in the COVID pandemic has been brutal. I would know because I held on to mine. But now that we see some light at the end of the tunnel with Pfizer and Moderna announcing their stunning vaccine news over the past couple of weeks, is it time to go bargain hunting on bank stocks? Well, if you're new to investing, the golden rule here is to understand what you're putting your money into. And so in this video, I hope to be covering a few key topics, mainly how the banking system works and how they make their money, what fundamental metrics to look for and what do they mean, and of course, how to value bank stocks to determine if they're worth buying or not. So without further ado, let's begin. Alright, so first things first, let's talk about how the banks make their money. Now, the banking system may seem like a complicated business, but an easy way to think about it is this. Banks are in the business of trading money. Normal people like you and me supply banks with money in the form of deposits, and in return, the bank pays us a small interest. Once deposited, the banks lend out our money to someone else in the form of a loan and charges the lender a higher interest rate. So in essence, the banks buys our money for a small cost and sells it to someone else for a profit. The profit margin of this lending business is of course loan interest minus deposit interest. And on the bank's balance sheet, this is stated as net interest margin. Ideally, the net interest margin should be higher than 3%. Now, you might think that a business with a 3% profit margin is really slim, and you would be right. But remember, money is like a commodity. It has the same value no matter which bank you use, and so any smart consumer will always go for loans with the lowest interest rate and deposit their money with banks that offer the highest interest rate on deposits. And so there is an intense price competition for banks to secure customers. In the case where profit margins are slim, banks hoping to earn a higher profit will aim to increase their loan volumes. This is why the loan growth rate is an important measure of the future profitability of banks. However, when you issue out more and more loans, you are also taking on more risk because there is a chance that some of these lenders will fail to pay their installments on time or to fail to pay at all. This risk is documented as the gross loan impairment ratio or GIL. A bank with good asset quality and risk management will have a GIL that is low, ideally less than 2%. Some banks though will choose to take on higher risks and issue high interest rate loans to riskier lenders in hopes to make a bigger profit. In this case, risk management becomes important, and a good metric to look at is the loan loss coverage, which is how much money a bank sets aside to cover bad loans that don't get repaid. Ideally, the loan loss coverage should be above 100%, and the higher, the better. Another thing to note is that banks cannot choose to loan out all your money to someone else because you will want to withdraw some of your money every now and then. And so, banks must always reserve a portion of cash to maintain its liquidity. And this is legally enforced as the statutory reserve requirement. In Malaysia, the SRR is only 2%, meaning for every 100 ringgit you deposit in a bank, the bank can legally lend out 98 ringgit to someone else. If the bank runs low on money though, they can choose to borrow money from other banks to maintain its liquidity. This interest rate that banks charge each other for these loans is the overnight policy rate or OPR, which is set by the central bank. When the central bank lowers the OPR, interbank loans becomes cheaper, and so you will also be paid less interest on your deposits. When money supply becomes cheaper overall, banks will be able to issue loans with a lower interest rate, making it cheaper for everyone to borrow money. The immediate impact of lowering the OPR will mean that banks will earn a lower profit in the short term. This is because the loan interest will be adjusted more quickly compared to deposits. However, as loans become cheaper, the demand will increase over time. The opposite is also true. When the OPR increases, the banks will be able to earn a higher profit in the immediate term. However, as loans become more expensive, demand will fall over time, impacting the bank's future profits. So as you can tell, the core lending business of a bank is heavily dependent on the OPR, something that the banks have no control over. Having no control over how much you earn is a bad position to be in. And so any good bank will try to diversify their businesses to include non-interest income. They can do this by imposing transaction charges, credit card fees, or to provide investment services. These income sources are not tied to the interest rate at all, and so it reduces the risk to a bank's earnings in case of a prolonged low interest rate environment. So to account for non-interest income, a better measure of profitability will be return on equity, or ROE. The ROE simply measures how much a bank earns as a percentage of shareholders' equity. Ideally, this ratio should be above 10%, and the higher it is, the more profitable the bank overall. So with this basic understanding, you can see how you can easily compare the performance of different banks by looking at its fundamental metrics. To give you a practical example, let's look at Malaysia's top banks. The green area on these four fundamental charts indicate the ideal range of metrics. For net interest margin and ROE, the higher the better. And on the risk side, we want lower GIL ratios and higher loan loss coverage. So a quick look at the net interest margin chart will show that none of the banks in Malaysia hit the ideal NIM of at least 3%. But when you look at overall profitability, most banks still consistently return ROEs over 10%. But a clear winner here is PBBank, which consistently outperforms all other banks over the last decade. On the risk side, CIMB, RHB, and Maybank have GILs trading dangerously above the ideal 2%, meaning they're issuing loans to riskier lenders and thus have poorer asset quality. On the other hand, PBBank and Hong Leong Bank have GIL ratios of less than 1%, showing great discipline in risk management. Their good risk management further extends to loan loss coverage, both of them covering well over 100% compared to just around 80% for Maybank and CIMB. So when you look at the fundamentals, PBBank comes out top of the class, followed by Hong Leong Bank. Both of these banks have very good profitability and good risk management, putting them in a better position to weather the current storm. So now that you've identified these fundamentally strong banks, the only question left to ask is if now is a good time to buy. Is the stock price reasonable or is it too high? Well, for bank stocks, a good number to look at will be the price to tangible book ratio. And this number is calculated by dividing the price of a bank's stock to the value of the company's net tangible assets. So in other words, this measures how much money you would get as a shareholder if the bank goes out of business today and sold all of its assets. When the price to book ratio is high, you are paying a premium for a bank's assets. So ideally, you will want to buy a bank stock when the price to book ratio is low relative to historical data. But remember, always choose a fundamentally strong company before you look at this ratio. Otherwise, it may not even have any meaning at all. Weak companies will always trade at low price to book ratios because they're not able to efficiently use their assets to generate income. If you look at this ratio for PBBank, historically for the past 5 years before the pandemic, the stock trades at around 2.5 times book value. But now, due to the pandemic, it is trading at a lower valuation at about 1.5 times book value. So it may be a good time to buy in. But when you switch to CIMB, however, you see that it's actually trading below tangible book value at about 0.8. If you just look at this ratio on its own, you might think that it's a great bargain. However, since you've already done the fundamentals, you know that CIMB is trading at lower valuations because of its lower quality assets and higher risk loans. So you need to take that risk into account. So that's all I have for you today. I really hope it gives you a clearer idea of how the banking system works, how to look at the fundamental metrics of a bank stock, and how to value bank stocks in general. I do want to mention here though that stock investing is not an exact science. So please do your own research and weigh your risk appetite before you put your money into any of these stocks. This is just a basic guideline that hopefully will steer you in the right direction when it comes to understanding bank stocks. As always, thank you so much for watching. Smash that like button if you understand what the heck I'm trying to say. Subscribe to my channel and I'll see you in the next video. Bye!